The Wall Street Journal has reported that the United Arab Emirates has demanded a possible financial safety net from the United States, including access to a dollar swap line. The discussions come as global economic stress due to the war in West Asia raises concerns. Hello and welcome to The Print. I am Samah Qundeel and I am here to explain what exactly is a swap line and why does it matter. A swap line is an arrangement between the Federal Reserve and another country's central bank. Under this system, the Fed lends US dollars to that central bank, which then supplies those dollars to banks and financial institutions in its own country. In exchange, the foreign central bank provides its own currency as collateral. When the loan is repaid, the currencies are swapped back. In simple terms, it is a way to ensure that dollars remain available across the global financial system. And that's crucial, because the US dollar is the world's dominant currency. If dollar liquidity tightens, countries might be forced to use alternative currency, like UAE proposing the Chinese yuan for oil sales and other transactions. That would be significant. The global oil trade is overwhelmingly conducted in US dollars. Any shift, even partial, could challenge the dollar's dominance in global markets. Banks, governments, and companies across the world rely on dollars for trade, investment, and borrowing. But during times of crisis, access to dollars can suddenly dry up. When that happens, financial institutions may be forced to sell assets quickly to raise cash. That can trigger market panic, push up borrowing costs, and destabilize currencies. Swap lines are designed to prevent exactly that. They allow the Federal Reserve to act as a global lender of last resort, supplying dollars not just within the United States, but across the world. And here's how it works in practice. The Fed lends dollars to a foreign central bank at a short-term interest rate. The central bank then lends those dollars to banks in its own country. Importantly, the risk of these loans stays with the foreign central bank and not the Fed. This system has been used repeatedly during major crises. During the 2008 global financial crisis, demand for dollars surged worldwide. The Fed expanded swap lines to multiple countries, with usage peaking at over $580 billion. The same tool was used again during the COVID-19 pandemic, when nearly $470 billion were drawn to stabilize global markets. But not every country gets access. The US has permanent or standing swap lines with a small group of major economies, including the central banks in Europe, Japan, the UK, Canada, and Switzerland. In times of extreme stress, it can selectively extend temporary lines to others, such as it did to Brazil and South Korea. The US Treasury has, in the past, used its Exchange Stabilization Fund to extend support, including a $20 billion swap arrangement for Argentina in 2025. And that's why discussions like the one involving the UAE matter. They signal concern about dollar liquidity, the ease with which countries and banks can access dollars when markets are under pressure. Swap lines do three key things. They cap how expensive it becomes to borrow dollars globally. They keep financial markets liquid by ensuring access to cash, and they stabilize exchange rates by reducing panic-driven swings. In short, they act as a safety valve for the global financial system, because when the world runs short of dollars, the consequences are immediate and global. And swap lines are one of the few tools powerful enough to contain that risk. Thank you for watching. For more such content, keep following The Print.